Foreign investors are already piling into Indian bonds ahead of the inclusion in June in JPMorgan's key emerging market index. For more on what this means, let's bring in Mirae Asset Investment Managers fixed income analyst and fund manager Kruti Chheta. Kruti, good to have you with us. Just a month away, and of course we've seen passive inflows making their way. In terms of the part of the curve that's looking attractive, what are you betting on?
So we've always seen that, foreign investors always want to front run, and like you rightly mentioned, we've seen that there has been a lot of participation. $9.5 billion already come into the bond markets, and this money largely has come into the belly of the curve, which is your 2028 to 23 segment. More also for the reason because these are the securities under the FAR route where the maximum investment is allowed by the FIIs. So we've already seen that from there on till now, the yields have moved around 25 basis plus. Now we are just a month away from, not even complete month away from the inflows that are expected. From here, we expect that there could be two ways. One is that FIIs decide to stay and the steady flows continue into the market. From there on, we will see that the yields will ease as the market participation increases. But in case these FIIs decide that since the inflows have come in and they try to exit and book some profits on counterparting these inflows in the past, then we might see a slight correction in the markets with these flows coming in.
So a lot has already been priced in, Kruti. In terms of yield movements, what other factors might come into play? How about the Fed's higher for longer, for instance?
So for global, yes, there is the tough situation for higher for longer, and the central banks are also, RBI is also playing on that higher for longer with the Fed as of now. But domestically, the situation remains very healthy for us because we have inflation within the target band. We have fiscal consolidation for last 2 years going on, and for the third year also, we are going towards the fiscal consolidation. And as we've seen, this current regime has not surprised, failed to surprise us on the positives. So we've already seen that to manage this through the liquidity, we've seen some government buybacks. We have seen that there has been reduction in the T-bill issuances, and in the new budget, if there is, and we've seen RBI dividend also coming in higher than double of what the expectations was. So if there is a more positive to come in the new budget, we would not be surprised on the yield fronts, and we would see that there could be more positivity relating to the India fixed income markets.
The thing is, Kruti, as we await results from the Indian election, what if it disappoints? What if Modi fails to get the majority that he wants, the mandate that he wants? How might this play out in the bond market?
So there are three ways or three situations to it that we can look at. One is that there is a number given, the market consensus is there. And if it does not come close to that consensus, then we might see that. But if it's still a majority, then we see that there is going to be a slight volatility. If with the coalition, the majority comes, there could be some course correction or some volatility in the near term, but as the agendas fit in, the longer term gets set in, we will see that again we are back to the track and back to the path that was laid down. But in case there is change in the regime or there is a new government to set, then obviously there will be a sell-off in the market, and the markets would await that what are the new spending going to be there and on what segments are we going to spend, or whether it's going to be more of the revenue expenditure or whether it's going to be more on the infrastructure expenditure. So in the case where there is a failure to set up the current regime, there could be some of the sell-off in the market.
You talked about the RBI's dividend, $25 billion, higher than anticipated. Would that necessarily mean a cut in borrowing in the new budget, you think?
If we have to look at here the speeches out of the current government saying that once they come into the power, they have like a 100-day plan which is already set out where they're going to spend. But again, like I previously mentioned, that this government has not failed to surprise us, and plus not ignoring the fact that we have 9 months of spending in this fiscal year. Because of the election, we've lost the 3 months of spending. So there could be a slight cut in the borrowing on that front, that because of the shortage of the time in this fiscal year, there could be cut down in the borrowings, and probably we see that in the next year, these borrowings could be added to the next fiscal year.
The next RBI meeting, June 7th, how are you weighing the growth and inflation dynamics?
In the next meeting, like the other global central banks are there, we are not expecting much of the action on the rate front. But because of, again, the elections, we have seen that the government cash balances have swelled up, and there has been, the system liquidity has been in negative. So we're expecting some of the action on the front of the rates, where, on liquidity measures, where they could, shorten their VRR windows, which is, smoothing of the liquidity, or they could formalize some of the actions on the government bond buybacks, or they could come out with a number on the government bond buyback. But as on inflation, right now there would be wait and watch, because we are awaiting monsoon. As of now, it is expected to be above normal, which should be good, but the spatial distribution of the monsoon remains key to us because of the food inflation having a higher allocation in our CPI basket. And on the growth front, we have GDP numbers releasing, which is expected to be around 6.7 to 6.9 as the market consensus, which is coming up. That will still bring our GDP growth above the first estimate, which was at 7.3% to around 7.8 to 7.9%. So RBI will show comfort on the growth front and wait and watch on the inflation front, and take some measures towards the liquidity.
Kruti, realistically, when can we expect the RBI to start cutting rates? I know that central banks around the world are waiting on the Fed, and expectations have already moved from 6, 7 rate cuts to now 1 or 2. How might this impact and shape, perhaps influence the decision by the RBI?
So when it comes to RBI, we have to understand one thing, that where the developed nations had gone on aggressive rate hikes, RBI had not gone for aggressive rate hikes at that moment. So largely to that extent, when there are aggressive rate cuts by the global central banks, that is when we can expect that there could be some of the rate cuts that can be undertaken by the RBI. Otherwise, we would manage mostly through the liquidity operations rather than going for a straight rate cuts, unless and until we are seeing that our growth rates are substantially coming down. But as of now, we don't see that the growth rates coming down substantially.